Hello and welcome to Econoday Unplugged. It's Tuesday, the 22nd July 2019. Mark Pender is stateside, Brian Jackson is already into Wednesday in Sydney, and I'm Jeremy Hawkins here in London. Okay, well, over the course of the next few days, we'll have important monetary policy announcements from the top four major central banks. What they decide to do, or indeed what not to do, will obviously have important implications for their own financial markets, but there could well be some significant knock-on effects elsewhere too. Particularly, for example, for the likes of the Swiss National Bank, which could be forced into taking action to prevent any further unwanted appreciation by its local currency. It's also the week in which we get the first look at second quarter US GDP and find out what lucky person will have to sort out the Brexit mess as the new UK PM. That will be Boris Johnson, by the way. OK, well, let's start with Brian since we have him on board today. So it's Southern Hemisphere. Brian, let's have a look at the BOJ. They meet next Monday, just a couple of days before the Fed announcement. So let's assume that the Fed cuts and that the yen appreciates as a result. So your inflation rate's well below 1%. Your JGB yield's kind of below where the BOJ wants to see them. So what can the central bank do to stop a stronger yen worsening the situation?
Well, they are obviously talking about some additional policy stimulus measures, but I don't think you're going to see, they're not talking about any changes in the main policy rate. So it's mainly sort of tinkering around the edges and, perhaps some additional bond buying or things like that. But, at the moment, it looks like it's still pretty steady on the rate outlook. We have had Governor Kuroda speaking at, I think it was at the IMF earlier this week, just talking about how he's a little bit more confident about the inflation outlook. So, even if the currency does continue in that direction, he still seems reasonably confident about the overall outlook for inflation, still gradually sort of edging towards that target. And so again, I think it's going to be just another month of interest rates staying on hold, but they will consider some additional if need be.
And how important is the level of the yen? I think from a market perspective, they've seen this 107 level against the dollar as being, kind of the bottom line as far as the central bank may be concerned. Is that right? Or do you think, dollar yen could go well below that level and the BOJ wouldn't be concerned or just would opt not to do anything about it?
Well, they're definitely concerned about the level, but probably more about the pace of moves. If it's sort of done in an orderly way, they tend to be a little bit more, accommodative of it. But they could also though just say, okay, well, there's only so much that we can do to actually to fight this if it does move that far. So again, I think they're trying to downplay the significance of it to the extent as possible. Obviously, they do get pressure from exporters, but if they can sort of point to the overall inflation outlook, I think that's what they'll probably prefer to do.
Fair enough. I want to have a quick chat about China since we've got you, but first, just sort of kind of in a nutshell, RBA and RBNZ. Mark and myself have been talking over the last several weeks about a general move towards lower interest rates, certainly states-wise and potentially within Europe as well. Do you think there's more to come out of the RBA and the RBNZ in terms of lower borrowing costs?
That's the way things are looking right now. I mean, the RBA has already moved, and they've made it quite clear what's driving that. In that they think that there is still scope to get the economy moving a bit quicker, get the unemployment rate down, and still not see any unwelcome increase in inflation. They think that the way that the inflation dynamics are at the moment, it can definitely tolerate a lower level of unemployment. And what we've seen over the last couple of months is that unemployment has been steady. You're not expecting, obviously, an immediate reaction to the policy rates cuts they've already put in place. So that suggests that it might take a little bit of time for those policy rate cuts to flow through to lower inflation, lower unemployment rate. So I think the bias, therefore, is definitely towards perhaps moving again. Obviously, we're getting already pretty low levels, so they're not going to continue it indefinitely, but there might be scope to do it a little bit more. In the case of New Zealand, it's again they've been pretty upfront in their policy statements, saying that definitely the bias is towards lower rates, given just the level of unemployment and what they're trying to do with growth.
Okay, fair enough. Perhaps less pressure on the People's Bank of China at the moment after the GDP numbers, which didn't look too good, but the monthly profile, certainly in terms of industrial production and retail sales, suggesting that things may be picking up towards the end of the second quarter?
That's what sort of the headline numbers suggest, though. There are, as is always the case with China, some doubts about some of the underlying data, and there are also some one-off factors that could be pushing some of those numbers. In particular, if you look at the retail sales number for June, that was it was well above expectations. But what seems to have been the main focus driving that has been auto sales. And what's going on in China is that you're bringing in some new emission standards for vehicles. And so that's driving a bit of a surge in sales before those emission standards come in. So there are some doubts about how sustainable, that strength in retail sales is. I think, the underlying message is definitely that, the trade situation is still having a big impact on the Chinese economy. A lot of angst, I think, about that headline GDP number. And what that means for the growth targets and particularly for industrial output. So I think there's a lot of concerns that policymakers are going to sort of go back to the old playbook and try and boost growth using investment in infrastructure, perhaps even trying to encourage property investment again.
Brian, this is Mark. I have a question about exactly that. The policymakers. What are the mechanisms of monetary policy in China? Is it the traditional central bank making interest rate decisions? Is it a government making fiscal policy decisions? How does this compare with what the Western model is?
Well, just going back 4 or 5 years ago, you did have, a reasonably active interest rate sort of policy in China, but that's really sort of gone off the table in recent years with what's been going on with the Fed and just quantitative easing all around the world. They've sort of taken that policy tool off the table. You still do see some moves in particular bank lending requirements, the reserve requirements, I should say, and also just using bank lending itself as a tool, directing the banks to lend when the government thinks we need a bit of a boost to the economy.
So let me stop you there. On the government dictates policy to the central bank?
Unofficially, yes. I mean, there is definitely some sort of official independence for the PBOC, but in practice, there's definitely a lot of government influence over there. The governor of the PBOC is a member of the State Council, so he is generally pretty closely aligned with what the government is trying to do, and so that does mean that monetary policy, is very much focused on trying to deliver those the growth targets that the government has in place. But as I said, over the last few years, they have also been moving to other sort of policy instruments, policy tools, and fiscal policy is also something that's being used to try and offset the impact of weaker trade this year.
Okay, thanks for that, Brian. Right, moving on then. Well, I guess before we move across to Mark, we should look at the ECB first. That will be the first of the big four central bank meetings taking place. They meet on Thursday, and all the talk from the various central bank officials, and notably Mario Draghi himself, since the last gathering on the 6th of June has really been directed, it seems, at boosting speculation that policy will be eased. And the two questions now would seem to be when and how. Now, the next economic forecast from the ECB, and normally they like to use updated forecasts when they do make certainly any major adjustments to policy anyway, they're not around until September the 12th. And that probably means that as far as this week is concerned, if we do see any kind of shift in their stance, it's going to be relatively subtle. Nonetheless, I do expect Draghi's conference to be very much of a dovish nature. I expect his speech pretty well across the board to really set the scene, I suspect, for something more aggressive once we get into September. In terms, I suppose, the options open to them at the moment, and well, what are they facing first? It's just the ongoing case of sluggish growth. It looks as if second quarter is only being about 0.2% quarterly growth rate, something like that. Inflation, core inflation, is still hovering around this 1% mark as it has for the best part of a couple of years or so now. So really, what can they do? So I think in terms of, well, Thursday, it's possible we could see some modification of the forward guidance. At the moment, that's still structured along the lines of interest rates being kept at current levels, with the view to perhaps some increase coming towards the back end of next year. So in terms of their reinvestment directive, that's very much centered around continuing to reinvest maturing principal until such time as we start seeing, well, beyond the period when we finally see interest rates being hiked. So I think taking out any notion that the next move in interest rates as being higher is certainly one thing they could do. And indeed, in the interest rate directive itself, which just talks about current levels being adhered to, they might perhaps introduce the idea that current rates or even lower rates could be the call. And that's the kind of directive or forward guidance they've used last time around about 2017 or so. So I wouldn't expect any big fireworks out of the ECB as far as this Thursday is concerned, but it does seem that they're going to be setting the scene very much, say, for a more aggressive move once we get into September time. Just quick in terms of the numbers out of the Eurozone this week to keep an eye on, really the key one's going to be on Wednesday, we'll get the July flash PMIs, and they're really just expected to suggest that the kind of soggy end to the second quarter we saw in the Eurozone economy is likely to be continued at the start of the third quarter, and that in itself will just be seen as increasing pressure on the central bank to come out and act. Okay, now we have a week or so to go before the Fed and the BOE, but Mr. Pender, we have the first look at second quarter US GDP on Friday. So is that likely to have any implications for market perceptions of what the Fed is likely to do next week?
Probably not, but it is very exciting. It's
like a man who's excited by GDP.
In the first estimate, and there's only the first estimate once, and the Econoday panel is at 1.9%, which annual pace, which doesn't sound that great, but that's because of corrections in exports and inventories. If, however, you look at consumer spending, the consensus is at 3.9% annual rate. Now, this will be preceding the Fed's presumably a rate cut announcement. We'll have this, which isn't pointing to the need for a rate cut or wouldn't point to the need. We have a strong June employment report, 224,000 rise in non-farm payrolls. We had a rise in core inflation in June. We had an unusually strong month in retail sales that this consumer spending reflects. None of this, and the best manufacturing month of the year, none of this is really fitting in with the incoming data and the need to cut rates. It's part of, I think, maybe a competitive rate cuts among the global central banks, kind of a version of currency devaluation.
Interesting. So I must say, at the moment, I suppose you've got a relatively strong dollar in the sense, trade weight is around 5-week highs, something like that. I wonder, is it the case, let's suppose, okay, we go into next week, I assume everyone's pretty well assumed there will be a cut. And what is it, 25 basis points? Yeah, best call. Well, let's assume if 25 basis point is built in now, and you're saying that the most recent numbers kind of raise a question mark over do they need to cut in the first place? Do you think then the statement from the Fed is going to intimate, well, look, we've cut interest rates, now we're going to wait and have a good look at the data? Or are they going to come out and say, well, we've cut once, but we're more than happy to come out and cut again?
I think probably the latter. I think that the former would be more reasonable. I think there's a background subtext that we have to address. I think it has to do a lot with or a comparison with China. We're having now a central bank whose independence is being challenged, has been challenged in a very dramatic and in not ineffective way. And so they're going to be moving now toward what the Trump administration wants them to do. So there might be a little resistance to that, but there really can't be quite a lot of resistance to that because of the political stature of the central bank. It's a secondary to the administration. So it's to actually get at what is the real truth, or what the people are actually saying in the elevators and coming down the hallway. It's going to be a mystery. And I think if you just look at it in the global sense, they're going to be poo-pooing the importance of incoming economic data, right? That's something that they never do. In fact, they've taken this year to dig out small reports. Jerome Powell digging out the Empire State, digging out the Philadelphia Fed, looking at these things and commenting on them and putting them in the press that this one went down and this is a sign that manufacturing is in trouble. Well, they're not all going down, and the definitive data is going up. So he's not going to be able to. It's going to be a fudgy, unpleasant rhetorical event. I think next week that's going to be preceded by not a proper build-up in the orchestra. The orchestra is going to be playing the wrong number when they cut rates.
In which case, let me round off with this one from your side, unless you've got anything else you want to add, of course. But let's suppose the Fed comes out and cuts by 0.5 percentage point. Do you think in that case the bond market might be spooked? Because on the basis of where you're talking the economy at the moment, how do you justify a 0.5 percentage point cut? So do you think that could actually cause more damage than it does good?
Well, if the damage is tied to the credibility of the Fed, it could.
Yeah, exactly.
Yeah. Because of the information on the economic side, there really it wouldn't be a warning of unknown economic weakness approaching. I mean, it could be with the trade and whatever, but we're not seeing it in the numbers. GDP in the U.S. has been performing much better than other places, and it's going to be on the consumer spending level performing even better. So it's a mess.
Okay, this is going to be an interesting few days, isn't it? Okay, let's quickly wrap it up then from this UK stuff, since I suppose a few bits and pieces I should be talking about there. As far as the Bank of England meetings go, we'll probably talk a little bit more about that next week. That will be on Thursday week. It should be said no changes likely out of that. And why is that? Well, more than anything else, simply because the Brexit issue has still to be sorted. But just for a touch on Brexit and our new Prime Minister, Mark, you were talking about sort of the idea of global interest rate cuts and that sort of thing. There's some interesting comment. If you're looking for an exception to the potential rule here, Andy Haldane, who's the Bank of England's chief economist, he was essentially looking at difference between how sort of UK economy is running at the moment and how the UK economy is performing. And a bottom line from his view for the UK is that lower interest rates in the UK, despite the fact that second quarter GDP over here could easily be a negative, are not really justified. And that's because on the Bank of England's estimates, the UK economy is pretty well running at full steam. So in other words, what they call the output gap, which is what they look at, has closed or is about to close. So really any kind of additional stimulus to domestic demand in the UK could simply result in pushing up inflation above its 2% target. So what the bank's really calling on for now is for some kind of additional stimulus to the supply side. So increased investment and this sort of thing. You're coming out of fiscal policy. So I know at the moment you've got this massive Brexit cloud, which means when you talk about monetary policy in the UK, you can't really see anything with any great conviction because we haven't a clue what's going to happen with Brexit. But it's interesting the fact that as far as financial markets at the moment are very much looking for the BOE to cut. We put Brexit on one side. If you take what the bank's chief economist is saying at the moment, it would still appear to be the case that it's more likely interest rates to be going higher rather than lower. Anyway, in terms of Brexit, then what can we say? Well, just raise that in the context. We will have a new UK Prime Minister. Boris Johnson, the former Foreign Secretary and one-time London Mayor, was duly announced as being the winner to replace Theresa May. He'll be moving into Downing Street as of tomorrow. Johnson, of course, is allegedly very much a pro-Brexit person, although for people with good memories, they may recall that originally he actually came out on the side of Remain remain. But he's intimating, crucially for financial markets, that he is determined to make sure the UK is out of the European Union by 31st of October, which is the current Brexit date by law. Indeed, it's always worth reminding folks that if nothing happens, then the UK will be leaving the EU at the end of October, simply because it's written into UK legislation. The problem, of course, with all this is still we may have a new Prime Minister now, but all the old issues are still very much there. We have pro-Brexit and Remainers split down party lines across parties, across the government and everything else. Johnson is promising, if necessary, he will take the UK out without a trade deal, which is regarded by most people, I think, as potentially disastrous. And crucially, Parliament still doesn't want to see a no trade deal Brexit either, which means it could be in for a very heated period once we get through the summer recess. UK Parliament goes off on its summer holes as of Thursday and won't be back until the beginning of September time. So it'll just be a few weeks between then and the end of October for Mr. Johnson to try and sort out what the heck is going to happen. Okay. Anyone else or anything else?
No, I guess just over that summer period, do you expect sort of Brexit to be just on pause, or do you think there'll be a lot of sort of?
Yeah, I mean, there's going to be stuff. Obviously, the press are going to be talking about it simply because the deadline is going to be creeping ever closer. But in terms of actual parliamentary business, nothing's going to happen because Parliament ain't around. I suppose I should actually mention just quickly that one of the measures which Boris Johnson had talked about was so-called proroguing Parliament, and by that he simply means that he could actually call an early end to Parliament to stop them voting on a measure which would prevent a no-deal Brexit. That now effectively has been ruled out by some measures which Parliament actually put through towards the back end of last week. But, see, in answer to your question, it's going to be dominating the papers and the press and everything else over here. But really, Parliament can't do anything until they come back in September time. And I'm saying the worrying aspect there, of course, is that this 31st of October date will just be very much a few weeks away. So could be a very choppy time for the pound. Okie dokie. Right, well, if that's everything, that'll do for our amble around global financial markets for this week. As always, keep an eye on Econoday's global economic calendar to stay up to date with all the major market moving events. Thanks very much as always for listening, and do tune in next week. Bye for now.